Many investors are feeling frustrated in this market because if you don't own AMD, if you don't own Micron, if you don't own SK Hynix, if you don't own a lot of the semiconductors, you have likely underperformed the market over the last year, and you watched all your friends and the S&P go up and all those stocks go up, but your amazing high quality companies, they are doing well and growing in earnings, they're going down. Not because they're bad companies, but because they're not as sexy as the semiconductors or Micron or the memory bottleneck trade or whatever. And many again are frustrated because of that. But I would personally take it as an opportunity to buy those stocks because they're going down for no reasons relative to their fundamentals. And those are the best setups that you could find in the market. So I'm going to talk about two of them today. And I really hope you enjoy it as always. The first one is SPGI, which is S&P Global. And I keep saying this, and investors don't really appreciate what it is to be able to buy SPGI near its lows pretty much for the last 4 or 5 months. I mean, this is a stock, guys, that barely used to sell off. And once it sells off, people go and buy the stock. People believe it will never trade at fair value because it's a quality company. But you have all those things happening right now, and most people are not interested in this stock. It's down 16.5% over the last year. They have about 5 businesses. I'm going to talk about each of them today, talk about the spinoff, the valuation post spinoff, and talk about it in general. Now, the first one is S&P Global Market Intelligence. This one is about 34% margin, is growing at about 8%. The market intelligence business is more of a data business. They have over 6 trillion data points that they can monetize around the S&P index and other kind of indices, energy and others, and they monetize the data and they sell it in a package. One of the most popular packages that they have is S&P Capital IQ, which you get access to the S&P 500 earnings estimates and earnings and margins and a lot of very valuable data that only S&P Global has in a very insightful way. So that's a pretty good business for them. Good margins, good growth, and it's a good business in general. The second one, which is my favorite one, is S&P Global Rating. So this is a rating agency where they rate a lot of the bonds, AA, AAA, BB, B minus, and they rate them. And you need to be able to rate them for them to be, you say, investment grade, or for you, other investors to be able to buy them. They need to look at the ratings of the rating agencies, and that's how those bonds become investables in general. So if you look back at 2008, 2009, if you watch The Big Shorts, S&P Global and Moody's were largely responsible for the 2008 financial crisis because they gave terrible mortgage-backed securities and other kind of securities, AA and AAA, and they were pretty much junk. So they were largely responsible for the crisis. But even the crisis of 2008 could not destroy the moat of those companies. Those moats are really, really deep. They have pretty much a monopoly between S&P Global and Moody's. Then you have Fitch and a few others, but those two pretty much control the market. If you look at the trend, you have about 8.2 trillion of corporate debt that's maturing over the next 3 years. This debt has to be refinanced. All of those things are tailwinds for the rating business of S&P Global, and that will only increase over the long term. I'm not saying a deleveraging event. I'm saying a leveraging event that will go on for many, many years and potentially many decades. So all of this is extremely, extremely bullish for S&P Global. Then you have the S&P business, which is mainly in the indices. And you could say this is one of the best businesses in the world, and because they benefit from active investing, from passive investing. So anything that has to do from active to passive, the passive flows have been increasing a lot. S&P Global benefits from it. Now, the way they benefit from it is maybe you've seen a lot of the S&P 500, let's say Vanguard ETF, VOO, and all these kind of S&P indices. Well, all those S&P indices, which have about 27 trillion in assets, they have to pay a fee for S&P Global to benchmark their ETF to the S&P 500, because the rights of the S&P 500 are owned by S&P Global. They own the index. And if you want to create an ETF that tracks the index, you have to pay massive fees to S&P Global. So again, how could you disrupt such a business? Unless people are no longer interested in the S&P 500, but people are more and more interested because they're not good at investing and then say, I'll just buy index funds. They buy the S&P, that creates more inflows, and people invest with the Trump accounts over the long term in the S&P. So this is a cycle. I don't see it ending anytime soon. So this is a business that you pretty much can't really disrupt it. Pretty amazing business, guys. Then you have the mobility business, which has Carfax. Carfax is mainly a lot of the records over years and years of a lot of cars. If you want to buy a car in the United States, you look at the Carfax report, see if it has an accident, if it was damaging, not too damaging, and everyone looks at Carfax pretty much whenever you're looking to buy a car or for car records in general. So they have a pretty decent monopoly or moat, you could say, around this sector. Most people know Carfax, about 96%, but they want to spin off the business, which I think will likely be a really good move, as it will increase the margins and it will make the company more focused in general. Now, if we look at the company's guidance, they have 1940 to 1965 for earnings per share guidance for 2026. But the problem is that this includes the mobility business, and the company is about to spin off the mobility business. So for us to calculate, and they're not going to receive any proceeds, by the way, they're just spinning it off in the market. So for us to calculate how much is the business worth or what is the earnings per share estimate without mobility, we're going to have to do a little bit of work, which I've already done. So what I pretty much did with SPGI is I took the mobility business operating profits, which is about 182 million. I took 182 million for the quarter and I annualized it. It's not perfect, I know, but it's pretty close, I think. I get about 728 million for 2026 in terms of operating profits. Now we have to take the taxes out. I'm taking 20% tax, so I'm timing it by about 80% to get the difference. This is about 582 million after tax, so pretty much 582 million in net income from the mobility business alone. I look at the shares outstanding, it's 296 million, so I take the number and I divide it by 296 million. I get about $1.96 in earnings per share for the mobility business. So if I take the $1.96 or about $2 out, I would come up with about $17.65 in earnings per share. So this is our 2026 earnings per share estimate. Now that would change the PE ratio a little bit, because the PE ratio right now is 20 times, but this is including the mobility business. If we exclude the mobility business, it's about 22 times earnings. Now 22 times earnings, at least on a historical basis, is very, very cheap for a company like S&P Global. This stock used to trade at an average PE of about 27 times, as high as 34 times, and now trading at about, you could say on an adjusted basis, 22 times earnings. So I think S&P Global here is not expensive at all for a company, 22 times earnings, high net income margins, one of the best moats you could ever have in the entire market. And you're buying it at 22 times, expected to grow 10%, 13%, 14%. This is really not bad at all. So I would say S&P Global is one of the highest quality companies in this market. They are trading at a discount, and I don't know for how long that's gonna last, but I think the stock is fairly valued to undervalued. I would see about a 12-13% annual return, something similar to the earnings per share growth, potentially a little bit more if we have an earnings per share reversion back to the average from 22 times to 27 times. So all in all, you could make pretty decent returns with S&P Global, and I think it's one of those overlooked opportunities in this market. Now, the second one is Mastercard, which I was against Mastercard, and I told you guys it's overvalued relative to Visa. And I was right, because Visa has been outperforming Mastercard so far. But Mastercard looks really, really good over here. This is another amazing business. It's down about 17% over the last year. Now, most people know that Mastercard is just a business that has to do with payments, where they get a fee on each payment that you make. But they also have something else called value-added services. And value-added services here has been growing much, much faster than the regular business, which is a volume-based business, or I should say mainly within transactions. So value-added has been a beast from 5 billion to 13 billion. It grew like crazy over the last year, pretty amazing, and it keeps on growing. So that's a pretty good business that's mainly tied to cybersecurity and other fraud slash security items. That's really, really good. This is one of the best business models in the world. It's about 45% net income margin, pretty amazing. Now, there's two reasons why S&P Global is going down. The first reason is Trump putting up 10% caps on pretty much credit cards, and it hasn't been implemented yet, but there's some fears that it could potentially be implemented. Now, I've seen other people comment on Mastercard, and they say that Mastercard is not a bank, so it doesn't really get affected by the 10% cap. The one that gets affected is JP Morgan, is American Express, because they have their own bank and they're benefiting from the fees. Mastercard doesn't benefit from the 10% APR or 20%. They benefit whenever you make a transaction. But the CEO of JP Morgan, which is Jamie Dimon, he said that that would really hurt pretty much everything else, because if you cap interest rates at 10%, a lot of high-risk borrowers with low credit scores will not fit in the risk model. So the reason why those low-risk borrowers have a credit card is because they give them very high interest rates for them to fit in their risk profile, because they have a history of not making payments on time. So if we cap 10% rates for everyone, then a lot of people would be disqualified from having a credit card, which would then in turn cause lower volumes for Visa and MasterCard. Okay, so that's a pretty decent threat for them. It could cause them a little bit of pain, but I don't think it warrants such a massive contraction. Now, something else that we have is the potential disruption of stablecoins. So people saying they're gonna be disrupted and then everyone will use stablecoins. But how about paying in person? Like maybe if an agent is using stablecoin to buy something online, I understand. But how about in-person transactions? Are we also gonna use the stablecoins? Do stablecoins also have cashback and rewards, which people like? Do they have the fraud protection that MasterCard have? Could you return something or dispute something with a stablecoin? Could you get all those benefits that MasterCard is giving you? I would say no. So for me personally, I'm not seeing how stablecoins will disrupt MasterCard. Maybe they could take some market share, but in terms of fully disrupting MasterCard, I'm personally not seeing it. Now we have another one, which is potentially the EU coming up with a new product to rival Visa and MasterCard. And MasterCard has a decent chunk of their volumes coming from the EU. Now that's a decent thread, but again, the EU is more of a touristic place. So a lot of people use Visa, they use MasterCard. They can't force everyone not to use Visa and MasterCard. So people will have an alternative, and maybe it will take some of the share that they have in Europe, but it's not going to take the whole share. It's not like people will lose all of Europe's revenue overnight. So I think this is also overblown, and I think it's just that investors are not finding it sexy enough. Now, if we look at the forward P of the company, it's trading at 24 times earnings. The company should trade at 50 times, guys. 50 times earnings. Average of 33 times. Now you could buy it at 24 times earnings. So yes, we could potentially have stablecoin disruption. Yes, we could potentially have some things from the EU. But I would argue a lot of it is priced in at 24 times. And the company has very little stock-based compensation. So this PE ratio is much more honest than AVGO's PE ratio or NVIDIA or AMD or those stocks. So I think 24 times is not expensive at all for a company that's been growing and expected to keep growing 15 to 16% for the next few years. So I believe MasterCard is undervalued. Between SPGI and MasterCard, it's a tough choice. But I personally would prefer SPGI because I love the index business and I love the rating businesses very, very much. And I think both of them are undervalued. And that's my opinion on those stocks. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.